I've had my order ticket ready, trying to find opportunities to sell to short euro, but nothing has materialized. And my only concern at the moment is if we don't get a setup pretty soon with news coming up. We've got ADP non-farm coming up 2:15. So just an hour 30, an hour 30 minutes, our 30 minutes, we must be out of the market, 30 minutes before the market, before the news comes. But we will see. So I've had this on for a while. I was looking out here. Let's just have a look at that. Let me take this away. I'll just keep a note of my stop level that I would like to get in it if it sets up so it doesn't distract us. So we've had this I call these macro wedges. It's a large wedge that was formed. This yellow bar, this yellow rectangle is the open of the UK markets. And where we opened, I mean, you don't want to, there's no ways you can jump into the market in the middle of a trading range. And we had a dodgy candle at the open. So always just put the measured moves in place. So I can take that off now, but you can see the market go to the measured move, tails on top, tried to reverse there, failed. Bulls, kept in control of the market, but they failed to break out above the 50% midpoint range of yesterday. And then when the market turned here, that's when I moved my wedge. That point, first we had that. Then of course, when the market turns, because you can see the full extension would have been there, but when the market turns, you just tighten it. And when you see an overshoot, that's perfectly fine. At some point, the bulls tried to break out above it, but they failed. You can see the way they failed at that level. And you could have also put a wedge here, or you should have, if you're in the market at that stage, you should have been observing this. So this would have been giving you indications of what the market can do. Now, this is quite interesting. What took place here, I mean, this was still in the Asian session. So, if you're looking at the market, what took place here, we had a wedge top. This wasn't there at that stage. So this could have been there. Okay, so what took place here is what, if it had taken place, by now I would have jumped into the trade. So we had a wedge top. You always want to see the potential reversal pattern. So the potential reversal pattern is a wedge top. All sorts of other things there, failed breakout above this tight trading range. And by now, price action traders, you should know we always just put in a measured move. So that is your measured move. Okay, and you'd have seen the wedge top. So there is the pattern, the wedge top. Now you wait for a lower high, higher high reversal, whatever it may be, perfect double top. And here you are given a perfect one, as perfect as gifts come in the market. That's the kind of trade you take, because you've seen the wedge top. There's a reversal at the measured move, failed breakout, test of the 50% midpoint. In that trade, 5:30 a.m. my time, 11:30, seeing, you take that trade and you see if you get down to here, or you can manage your trade. You'd have made some decent money at that point. And then, of course, afterwards, what we are looking at is that whole process at a much larger time, larger frame of time, a huge wedge. Okay, and now I was looking to try and get in at this level. And I'm always looking for this kind of high test candles, inside candles that are complete candles, not dodgy candles like we had, failed breakout, that would have been, a decent enough trade for me to take. But I wasn't rewarded with that. And the doji, and you don't want to sell beneath a doji because a doji is a trading range. When you get a trading range, you always have to anticipate that any breakout is likely to fail. So the market could have accelerated all the way down here. I mean, if you're taking the chance with that, very low probability trade, which I don't do, you would have been deciding here, do I stay in the trade, don't I? But you would have been able to manage it and exit at, well, you wouldn't lose money. You'd manage it by now, probably tighten your stop. But I was looking for that. Now, the fact that we didn't get that does not change my initial higher probability search for shorts on the euro. But what I need to see now is I need to see how the market is going to come back to that level in that zone. I've got to look for some form of a double top. It could be a perfect double top, could be a high double top, fail breakout, or a lower high. Then I'll be able to, comfortable to jump in. And what if you don't get that, George? Well, that is perfectly fine. I'm not going to jump in anywhere here. So I've got to wait, but I had my ticket ready, ready to press the button to say sell. Where would my stop have been? You can see I left my measured moves in there. So that was the trading range in operation at the time for that very first trade, 0.25% risk. I'll talk about capital allocation just now, but I'll show you guys just a few slides that I have just to share my thoughts and thinking on how capital allocation should go to preserve your capital and optimize the profits. So at that stage, if I'd had the signal here that I was waiting for, stop at that stage was 20 pips. That was a 20 pip stop at 0.25%. And of course, if it had gone my way, would have continued building the position as we go along. So gotta wait for that. The only little problem is how long it's going to take to set up. Bear in mind with ADP non-farm payroll, you just have to be clear that there is news that is coming that might shape or move the markets, and we need to settle down for us to get clarity on our price action structure. So looking for shorts in that zone. Another setup that was interesting to me, still interesting, but it's taken a little bit longer in terms of setting up the way that I would have liked, was looking for longs on the UK 100. So as I'm thinking, I think I missed a step on euro. Apologies. Let's go back to euro. I want to just show you euro on the daily. Okay, so euro on the daily is absolutely interesting. So that was the first candle of the month, doji candle. Whenever you see a doji candle on any chart, you have to know that it's a trading range. It's a 1 bar trading range. So a 1 bar doji is a 1 bar trading range, and you have to be aware that any breakout either side of it, either extreme, might lead to a measured move. So I've already marked on my charts the measured move of this doji. Okay, because the market will get there at some point, test it, reverse, blow through it. You don't want to be surprised, say, hey, hang on, why is the market doing what it's doing? If you have a look, let's have a look on this candle here. This was the 24th of October. Just keeping my eyes glued on YouTube as well as the other charts so we don't miss anything. Okay, so if we look here, measured move of that 1 bar doji was here. The market got to the measured move, which was parity, that a big round number of 1, broke out above it and failed and came back and closed within there. So, and that measured move was also the same height as this 2 bar reversal. So the market was aiming to get there to test it and try and break out above it. If you also look at this one here, That's not a surprise, right? The one bad doji we had on the 28th of October, I mean, as perfect as you could make it, as you could land it. I mean, I've told you guys I'm a private pilot, so my instructor always say, hit the numbers, George, hit the numbers. When you come in to land that Cessna, if you hit the numbers perfectly, that is perfection. That's as perfect as took place here. I mean, out of that measured move. So we don't get surprised by this. If you're in the market and the market bounces off there, take your profits, take a reversal trade, whatever you need to do. So that should have left it in there. So just on the sell side, there is a measured move. I'm just leaving it there. I mean, if you look to the left, you can see broke out beneath it, trading range, try to break out beneath this level. The bears want to get to test that and see if they can crush between that, beneath that. And let's just move this here. Of course, once you get down to there, there's other levels here. You want to clutter your charts. If the market breaks beneath that, you can just move that line to there. Is another level that is likely to be tested because the bulls reversed the market quite strongly at that point. So that's going to be tested at some point. But the first point is the measured move. Of course, if we have the market breaking up to the upside, there is a measured move, again, testing these key levels that we have. Let's not worry about that. Let's not get distracted. I would talk about that, in fact, a little bit on TTR this Sunday. I'm going to look at the structure of the euro versus the dollar and talk about some of these levels that we've got. So just leave that in there for us not to get distracted. So let's wait and see if we can get a setup on that. The other market, UK 100. Now, with UK 100, after that doji at the open of the UK markets and the market pulling back into the middle of the trading range to test the midpoint. Now, this level, I'll show you on the daily just now, that's the midpoint of the 2022 range, an absolutely critical level in the market, because wherever the bears want the year to end below the midpoint. Okay, makes sense logically. The bulls, of course, want the market to get back above the 50% midpoint of this year's range. So seeing that as a magnet, there is the open measured move of the open would have been just below here around the 50% level. My anticipation at that stage was that would get a wedge bottom, which we got. And now I was waiting to see if we get a higher low. And that candle, 15 minutes before we opened, kind of got me to think, oh, okay, the bulls are coming in to try and buy and create the double bottom that I would have seen. There is the wedge bottom. If you've seen a bull candle, double bottom, happy to buy above that market. But unfortunately, that candle, big tail at the bottom, good for the bulls, but the bears controlled it. So bears have been controlling the market. Bear inside candle doji, low test, just for a breakout. And now we have a huge candle selling off. So bit of a waiting game. And I always want to have a look at the market to say, where could I have jumped in? That was the first candle of the day, and I don't like trading just before the market opened. So all along here, no opportunities for me to have jumped off. So my whole thesis was to wait for the higher low, for the double bottom, whichever way it had formed. But I got to wait and see what the market presents for us. So a bit more waiting on the UK 100. Let's just, I'll go to the daily just now, just flip back to the euro. Okay, so we got to wait. Now, question is, George, you're waiting to sell here. What happens if the market comes all the way down here? Well, if the market comes back here, it is still in the buy zone because it might create a double bottom, which will be a higher low double bottom. So I like a little bit of precision with my lines and charts. So there it is. So if we get down here and we bounce off here, give us a double bottom, and we then get a decent enough higher low, then you can look to buy. The problem again that we're going to get, a double bottom can come anytime, but it might take 4, 5, 6 candles to get here if you get a double bottom. Okay, and if it's structured correctly, low test, bull candle, whatever it may be, then you say, okay, fantastic. Let me just wait to see a bit of bull acceleration of that, get my higher low. You just have to bear in mind how far you're off the news. So my preference is to shorten somewhere up here. And if we get down here, assume we get down here in this time before the news and all of that stuff, get double bottom higher low, you can look to trade, but it has to be as near perfect as you can, a double bottom and a higher low, because if we get a doji of all sorts of bear candles here, which is a failed double bottom, then the market has to come down here. Okay, then we have a huge trading range created, and that makes it even easier. You buy at the low for trading range, you sell at the top of the trading range. But first preference is up here, so we'll keep an eye out on that. UK 100. All right, so let's see how many minutes do we have. This is a couple of minutes into this candle. If the bears are strong, this is the breakout candle. Okay, none of this, all of these that we have here are all part of an attempt by the bulls to create a double bottom. So if the bears are strong, then I have to give a strong follow-through candle. And if they give a strong follow-through candle as a trend candle whose body is bigger than the tails, they give us that, fantastic. The bears are in control of the market. We have to go through the whole cycle again of saying we have to now wait for the pullback to test the breakout point and see if we can jump into the market. But they have to give us that strong candle. We'll have a look at it just now. In the meanwhile, let's go just to the daily chart. So the bulls, I mean, this was a key level, the old high of October, before they created a new high just at the end of the month. That was a key level, which was a key lower high from that bear breakout, that bear sell-off, lower high. So I think you might remember I had it for quite a while on my charts, but I took it off, of course, after it's been broken. Failed breakout, so that kind of indicated problem for the bulls. I mean, if they're working so hard, they just need to give a strong breakout, right? But we had a tail on top, so a bit of problem for the bulls. However, next day, that closed, bit of a gap up. It was a big gap up if you looked on the 5 minute from that close to that open. And the bulls could capitalize on that, but they got to the end of the day and they pulled back. And there was the bears who had created this, and the bears who came in to prevent the bulls breaking above this huge bear candle. So that again, this is, let me show you now. So that level, which is the height of this bear candle, is what has turned out to be the 50% midpoint of 2022 after this low was put in. So there is my fib levels. There is the low of 2022. There is high of 2022. There is the midpoint of 2022. So that's where the market is. And we work out this, of course, every time we get a new low, we do old high to the new low, and then we're on 50%. Then you look and say, well, what has the market done around that level? And you can see how significant that level is. I mean, there we had the huge bear breakout, but also we tried to break out beneath it, and the market is kind of oscillated around that level. So that's a key level, just to keep on your charts until the year is done. You know, just leave it there and be guided by it. You can see the bears are defending it, are coming off it. So it wouldn't surprise us if we get a huge bear candle. If the bears are strong, they want the market to accelerate down, they have to get through this big round number. Okay, so for the bears, it's come off the 50% of the year, sell off to get beneath the big round number of 7,000. That's a key level of resistance, the key level of support. The market tries to test it. And of course, you know, there is enough time for the market to get back and create an even lower low for the year. So that's kind of the view on the daily for the UK 100. In addition to that, when this level here, high of bear, outside candle, this huge outside candle, it's key level. Market also created an inside candle, breakout more to that level, tested that level, breakout beneath that level. So there is still this level. So even if the bulls are able to turn this around, they will not have completely taken over the market until they can clear this level. And then they have to worry about just having a trading range. So in my view, the higher probabilities based on the read of the charts is still a bearish market. Higher probabilities bearish market. But we will keep our eyes on it. So the bears gave us a breakout candle, fantastic, small tails, but still a bear candle. Now we want to see what kind of pullback we get. If we get, when I say what kind of pullback we get, because if the market is broken out beneath key level, let's put it in there. So I hope all the price action traders had a decent month in October, and that you have an even better month in November. So that's the level, wedge bottom. Okay, so there was another wedge bottom here at the measured move of the first candle. So the market has broken out beneath that. There is follow through. So if we're looking to sell, as the bears are selling, we want to see that any pullback, if we're looking to sell, any pullback must at least be two-sided. It must not be strong, consecutive, successive bull candles, because if bulls are creating those strong bull candles back to the area of test, it means that the bulls are coming back into power, if that makes sense. If we get two-sided price action, dodges, bull, bear, etc., then we say, okay, the bull move to test the breakout point is weak. So if we see a decent enough reversal here, then we can comfortably sell. We just worry about where to put our stop. Okay, so our concern at the moment is how the pullback is going to be. Couple of seconds. Okay, so this is all good for the bears. The price action that's taken place. Sorry, I just see a question I should have answered. Sorry, Gary, forgot to answer that. The yellow box is the first candle of the open of the UK, the London Stock Exchange, the UK session. So I always want to mark that, because anytime the market opens, it's essentially like trading news. You got to see the strength of that and try and then look for trades out of that. The fact that we had a dodgy candle just means that we have to wait for clarity in terms of our price action. Okay, just checking on the other traders on YouTube. All right, euro versus the dollar. Okay, we're still in a tight trading range, area of agreement, and sell zone up here. Buy zone if you get a strong double bottom, and the high low is here. If you get the market doing trading range and breaking out, do not buy anywhere in here. You're going to have to wait until the market gets to the low of the trading range. So only if you get a strong, I mean, if you to get a candle like this, what other candles, any kind of strong bull candle here to create the double bottom, then you want to see the acceleration of it. So it's a strong double bottom. Then we look for the higher low. Hang Seng 50, I'm going to tell you a story about Hang Seng 50. Beautiful market, opportunities are right in from the open. And then, the market closes and you come back. And I'm looking, I'm saying, but what is happening here? What's taking place? I had to get a hold of my broker and say, buddy, how come the Hang Seng 50, there's no price data being fitted in? And he said, hold on, well, I'll get back to you very quickly. If you want to take trades, let me know. If you want to get off trades, let me know. I'll make sure you filled in correctly. And he comes back and he says, oops, there apparently is a typhoon that was about to, or is, it's probably hit Hong Kong, and they just shut the market. So my broker just stopped all the feeds on the market. And I said, oh, okay. Thanks, buddy. It just goes to highlight the whole issue of capital allocation, capital management, and always having stops in the market, all of those beautiful things, because you just don't know what's going to happen. So you always make sure that you are protected in the market in terms of what you do. Okay, so we've kind of spoken about this. Let's speak quickly about S&P 500 before I show you a few of my slides on capital allocation, capital management. S&P 500, there was the first candle of the UK Open. And at that point, a low probabilities sell setup. Now, when I say low probability, if you're taking reversal trades, which I always look for consistently. So I'm always looking for reversal trades. If they set up, I want to take them. They are lower probability because out of a basket of 100 trades, I know I work on 40 going my way and you make super profits. The other 60, you have to manage them. And if you manage them well, you don't lose money. Going in at 0.25%, break even, small losses, and that's perfectly fine. But when I mention that a reversal trade is a lower probability trade, it's even lower than 40%, but you can take it provided you put in your stops in the correct place. So one setup on the S&P 500, which fits in with strategy number 4 for the guys who sat through the course. So there was the first candle, bull candle, trading range candle, tails on top. Problem was the inside candle and then the dodgy candle. So you see we are in a breakout mode already because of the trading range. Then we had this huge bull acceleration right at the level where macro wedge was set up, test of the measured move of the first candle. Inside candle, absolutely fantastic as a breakout mode. Then we had a series of dodges. So on seeing that series of dodges, because this is also a convergent triangle. Remember when we said, whenever you see a convergent triangle and prices, it could carry on like that, but it's not going to carry on like that forever. So the price is not going to end up as a straight line. So whenever you see a convergent triangle, you can expect a breakout, a pullback to test the apex, and then the continuation of it. So let's just remove this. The low probability trade that you could have taken, and you could happily take that, was beneath would have been beneath that convergent triangle. Anywhere within there would have been fine. Your anticipation that after the breakout, the market will come back and test the apex and then sell off. And if you wanted a higher probability trade, you'd have waited for that breakout, come back to test the apex and given you a decent enough bear candle, sell beneath it. But you didn't get it. So the low probability trade, kind of worked out. But you'd have to get down here and decide what you do with it. Your stop, measured move of that, just somewhere above there. Measured move of the convergent triangle. So your stop would have been $10. Okay, $8, put $10 stop on the S&P 500. Your goal will be to get to here and then to see if you can manage it. So 1-to-1 on that and try and manage it. You could have exited anyway in here if you didn't want to sit through all of this. By the time you get a bull candle above the 10 EMA, I would have exited. You don't know it would have done all of this, but it's done that. Now, what we have is, or what I'm looking for, is an opportunity to go long because of this failed breakout so far. Double bottom, the very weak acceleration of the bulls. Bears came back, but we're creating tails at the bottom, back to the magenta line, the purple line. That is the open of the day. So on the day, we have a perfect doji at the present moment. There is that little doji right there. Let's see what we have at the present moment. I think it's my fibs are not kind of showing there. And that should be fine. So on the day we have a perfect doji. Now, looking on the day, you can see again, tried to break out above the high, failed. Beautiful bull candle for the bulls. The only problem with this candle for the bulls is that it is an entry candle above a bear candle. Okay, so the bear candle is a bad signal for the bulls. If this had been a bull low test candle, the bulls, you can expect them to accelerate. But because the bulls had a bad signal for their entry, you can expect that the bulls will fail at some stage. Okay, let me say that again. Good for the bulls. Okay, outside candle, bull candle, we know failed breakout, weakness, etc. But if this candle that came back to test the EMAs had been a bull candle, followed by a strong bull candle, you can expect bulls to accelerate a bit further. But the bulls had a strong candle coming off a bad signal, so you can expect the market to fail. Now, this level is here, low of 13 September, bear breakout, and high of 20th of September. So it's the low of this huge candle and also the high here of this candle. So that candle will be defended by the bears. They had a huge bear candle reversed in 4 days, 1, 2, 3, 4 candle closes. Okay, bit of a pause and the follow through, expanding triangle sell-off. So the bears are going to defend this. So all the bulls did with this, with their bad entry, bad signal, was to test this level. And the bears are defending. Inside candle yesterday, if the bulls had been strong, they would have accelerated past it to go and test the big number 4,000. But an outside candle, so right now the market structure is favoring the bears if you look on the daily. But what the bears need to do is break beneath the low of yesterday and sell off aggressively. The bulls want to make sure that, okay, we've failed to break up above that, but let's create a doji candle, let's pause the market, whatever it may be, so that we can get successfully to test again the 10 EMA and then have a decent enough reversal signal so we can all buy and everyone can have merry celebration to get to the big round number 4,000. So with that in mind, with the market favoring the bears, we need to look at the structure on the 5-minute and be open to see if the bears are going to capitalize on it. At the present moment, the bears are not capitalizing on the market. Okay, they need the bears are strong and they're going to capitalize on the market. They need to get down to this level. Okay, they need to follow through and break out beneath this level so that this whole measured move can come into effect. I don't want to run out of time to look at capital allocation, so I will move through this quickly. Okay, so the bears have this opportunity to break out beneath this level and get down here. But I mean, if they're breaking out, why are we failing at the open of the day? So while we know the bears have to get here, and on the daily chart, if you look at it from where we open, from the open of the day, it's not far to get there. You know, it's only $10 to get there, and you already have a range of $20 to get there. But this is where it gets all very interesting. The bulls will defend this and try and create a double bottom. Okay, so if we get acceleration from here, in other words, successive bull candles, and we come back and create a double bottom, to be a lower double bottom from here, that's perfectly fine. Then we can look to buy. But if you're going to buy, you have to be comfortable to put a wide stop to beneath this low, the low of yesterday. If you're not comfortable to put a wide stop, do not buy. Okay, because we are looking at this stage, if it sets up, it's not looking to set up, it's left to wait for acceleration up, a close above the EMAs and the double bottom. If that sets up, you have to be comfortable to put a stop here of $10, wherever it may set, because the market can still test that. But your reward, if it goes your way, will be an acceleration into the stratosphere. But you have to wait. The inverse of that, if you say, George, hey, I'm not going to take this, I'm not prepared to take that deep level. If the market accelerates off and you haven't taken a reversal trade, perfectly fine. Wait for the pullback to the EMAs and take a trend trade, higher probability, less profits. Fantastic. You just have to put your stop here after we get that. Okay. If the bears surprise us and give us a huge bear candle, another bear candle to close beneath the low of here, which has confirmed the breakout low of yesterday, and we're still going to sell. Okay, now let me quickly, in 5 minutes, I want to show you something which I am pretty certain is going to assist you in being patient. One of the things that I mentioned in the course is that 5-minute price action traders are low frequency traders because you wait for your things to set up. When they set up, if you manage them well, there is a potential to make good capital out of one day, capital growth. So here's what took place in a particular market. I'm not going to worry about explaining the strategy. One of the strategies that we discussed with the guys in the coaching. So I'm not going to go into it, but you could have taken a trade here. Okay. So let's say you didn't take that because you didn't understand the structure, but there is a trade you could have taken. If you didn't take that trade you have to take because you have an expanding triangle bottom at the high of yesterday. When this kind of pattern fails, you can definitely look to sell beneath there. Excellent. I'll be done. Thank you. So you must sell beneath there, okay? And if you are looking to capitalize your profits, you have to hold on to your trades. You could always sell, see a reversal, get out of the trades, take the next trade, okay? Sell beneath here, see a potential reversal, get out, bank your profits. You could do the same here. Take this trade or that trade. You don't take both. They're both within the same kind of zone. Get to the bottom, look to take your profits. If you don't manage your trades, you can bank that and get your profits and go away. So keep that in mind. Now, talking about capital allocation and capital management, this is how you could have traded it. The first trade you could take at 0.25%. By the time the day ends, by the time you get to 2 p.m., that's plus or minus 10 hours in this zone, if you'd taken the first trade at 0.25%, it would have yielded for you a 2-to-1 return, and on that, that's 0.5%. Okay, if you didn't take that trade, if this becomes your first trade, then you just change the percentages, of course. But if you had taken that second trade at 0.25%, or if you hadn't taken that, you had taken the other one I had did at 0.5%, by the end of the day, the 0.5% just by holding on to your trade would have yielded for you 3-to-1, and that particular trade would be 1.5%. If you've been waiting and you see this setup and you take this trade, of course, you can now tighten your stops and taking that trade or that trade or that trade. All of these trades are in the same kind of zone because they haven't gotten to 1-to-1. But you find in trades to hold on, you take that, hold on to it, don't take anything else. You take that, hold on to it, don't take anything else. Or you take that, one of those. Any of these trades would have yielded for you a 3-to-1, that would have been 3%, because now you're going from 0.25%. The next trade is 0.5. The trade thereafter is 1%. And if you had hung around long enough and taken trade number 4, 2%, because now the next one is at 2%, your yield would have been 4-to-1 because it's a tighter stop, and you would have banked on that 8%. By doing that, you would have banked 13% in one day. Alternatively, if you had been taking your trades and banking them at a reversal, taking your trades, banking them at a reversal, banking them at reversal, that 13% could have been at least a 4 and 5% return on one day. But that all comes from capital allocation and capital management. The date is, this is my date today. This is today's date. I just made a note for myself. Live trading profits today. So I'm describing a chart that took place 5th of July on today's date. That's what that means. But I'm showing you just how you can start to think about capital allocation and capital management. We'll spend a bit more time on it, but you have to invest as much time in capital allocation as you do in your trades and your patterns. Otherwise, you will make money, but not make as much money as you can. Or if the trade goes against you and you just by putting 1% in, you lose a lot more money. All right, guys, we are right there with a few seconds to spare. I just want to have one last quick look at the market, euro versus the dollar. Okay, let's keep waiting, keep watching that and see if we get the trade. And then Hang Seng, UK 100, there's my alarm. S&P 500, let's see if we get higher low, double bottoms and look to trade that. But be aware of the news. Thank you very much, guys. Sincerely appreciate it. We will catch up with you again next Wednesday. Take care and bye-bye. Thank you for hosting back in the office. Appreciate it. Bye-bye.